I'm very happy to elaborate on the economic policy response to COVID-19 that has been engineered by the European Union. Up front, I think I would like to tell you the two main messages I would like to stress today. First, I think that this crisis response, came early and was significant. And that's important because it contrasts very much with conventional criticism that we have on the EU, which is typically, along the line, the EU does too little, too late. I've heard that many times, in particular, in the context of the global financial crisis, but this time really has been different. The second message I would like to stress is that this deal, this historic deal that we had after 4 days of the July European Council was made possible really by a strong political drive from the very beginning and the involvement of EU head of state or government for this process. So, what are the key elements of this deal? If I had to summarize in 3 points, I would say, well, after 4 days, 4 days and nights actually of negotiation from the 17th to the 21st of July, what emerged is 3 things. First, Europe had an agreement on his budget. On his budget, which we call in European parlance as a multi-annual financial framework, which is the budget over the next 7 years. This was the first thing. The second thing, most importantly, was an agreement on the recovery fund, which is dubbed as the Next Generation EU, was dubbed as Next Generation EU by the European Commission when it tabled its proposal. This is a 750 billion recovery fund, of which 390 of grants and 360 of loans to the EU member states. The third is an agreement to amend our own resources decision. What is the own resources decision? It's the decision of the Council that actually provides for how to finance the Union budget. And it's a very important decision, actually, that has to be adopted by unanimity and actually even ratified by national parliaments. This decision will allow, actually, the Union to borrow on financial markets, not only to lend money to member states, but also to give them grants. So whereas, as you know, lending to member states is not new in Europe, this has been done, many times, and in particular in the context of the previous crisis, giving grants financed by borrowing on financial markets through the Union budget is really groundbreaking for the Union. So why was this time different? One thing that is very important is that very early there was an understanding of the systemic aspect of this crisis and the need for a common response. So it was seen as a threat to the Union as a whole. It's also due to the symmetric nature of the shock, because it's a shock then, that came to all of us, and in fact, as a fate of nature, which was also very important because the fate of nature and responding to a catastrophe, a natural catastrophe, is more prone to elicit solidarity among member states than a situation that is the result, for example, of ill-designed policy in a specific member states. Of course, during the crisis, which came very abruptly, in fact, and exploded almost in our face in a couple of days and weeks. At the very beginning, the first in line were the member states, and they reacted very forcefully, both on the sanitary side, but also on the economic side by providing support to citizens and businesses, both through automatic stabilizers, but also through discretionary spending. In this context, and that's very important, all EU institutions actually, in addition to the member states, lived up to their responsibilities. So there was a kind of very proactive, in fact, mood, policy mood in a sense, that made possible to design, timely solution to the challenge. And then all EU institutions came with proposals and ideas or decisions, to make things possible. First of all, the Commission very, very early, changed or adapted the stated rules to allow member states to give them the room to support their economies, to support the private sector. Then they activated very early on the general escape clause of the Stability and Growth Pact that allowed actually the member state also to have a significant fiscal response and to be also certain that they will not have problems with the European fiscal rules. And then the Commission, came with an additional proposal. It's called SURE proposal. To support, short-term unemployment scheme. It's not a small proposal. It's lending to member states. It's 100 billion. Actually, it's being implemented now. Has been implemented. And these stand, this called, a European instrument for temporary support to mitigate unemployment risk in an emergency. So if you're in this big title, you will find the 4 letters of SURE somewhere. But this, was, something that was very important also to maintain actually citizens, workers in employment. Then the European Investment Bank came also early on in the context of the Eurogroup and the finance, the ECOFIN, with the proposal actually to create a pan-European guarantee fund. That's being implemented now, and that allows, in fact, to support access to finance by European firms and in particular in SMEs. The European Stability Mechanism also, creatively set out pandemic crisis support on the basis of existing credit lines, and that acts as an additional safety net to member states. So, what's very important, in particular, to support, favorable financing conditions to European member states, to EU member states. And finally, of course, the ECB was also very active, took bold monetary policy decision, but they also on the supervisory side, there was also supervisory guidance to support lending by banks to the economy. So my take on this is that, in fact, this creative policy response was made possible largely by institution building and the lessons also, the institution building that took place in the aftermath of the global financial crisis, and also the lessons that Europeans drew from the sovereign debt crisis. So now on the strong political drive, it's mainly, all what has been done, I think is largely attributable, in fact, if not uniquely, to the strong political drive at the leaders level. It's very important because, in a world of heightened uncertainty, and I think we are living in a world where we don't know much about what's going to happen. There is, conjunctural uncertainty, but there's also structural uncertainty. So, in fact, we don't know where we will be even next week or in 2 weeks, even not where we will be next year. So, it's extremely important, for leaders to set out strategic orientation so that at least you don't end up with a situation where you add policy uncertainty to intrinsic uncertainty in your economy. So that was very important. From early March to the July European Council physical meeting, when the deal was agreed by leaders on the recovery fund, the President of the European Council, Michel, convened 5 video conferences of the leaders. So they were fully engaged, all the European leaders, in the design of the overall policy response early on. Of course, the starting position on the appropriate economic policy response, and that's not a surprise, were initially 4 apart. And they even started this discussion in a very divisive, it was, even emotional, in particular when there was this debate back in March, actually, about Corona bonds, for example, and this, actually the idea of borrowing for spending that was behind. Then this debate was very emotional, very divisive, and the notion of grants to member states, for example. So this notion of borrowing for spending was actually a clear red line for a group of member states. And so it was, kind of a difficult moment, in fact, in the policy discussion. What President Michel did, over the course of this video conference was to bring this debate from emotion to reason. Along this sequence of meetings, he could first, gather an agreement, on the package prepared by the Eurogroup that consists of what I mentioned just before, the SURE, the ESM pandemic crisis support, and also the EIB Pan-European Guarantee Fund. And then from that, and also from the work of the Commission on the assessment and the needs, the needs, the recovery needs, by end of April, leaders at least had a common understanding of the need for a recovery fund. But they had no agreement at that point in time on the characteristic of it. And so there, what was important was actually to task the Commission to make a concrete proposal. So to bring this debate, on to concrete measures. What can be done? What is possible under the constraints that we have? By mid-May, one important moment was that France and Germany agreed on a recovery fund, including borrowing for spending. And the fact, I should stress, that member states could change actually their red lines in the course of the policy process really testifies to its intensity and also to the magnitude of the crisis, of course. Then the Commission, end of May, came with a proposal for a recovery fund of 750 billion, so even more than what was in the Franco-German paper, because it was envisaging 500 billion of grants. And in its initial proposal to the European Council, the President maintained this degree of ambition, so 750 billion of recovery funds, of which 500 billion of grants and 250 billion of loans to member states. Of course, the deal, during the negotiations, there was a sort of reduction in the amount of grants to 390 and an increase in loans to 360 billion. But overall, the overall package still remained at this level of 350 billion euros for the EU as a whole. So this strong political drive also led to a transformative recovery package. So this recovery package is not only about, let's say, addressing the conjunctural situation and the immediate impact of the crisis. It also combines structural objectives with the need for macroeconomic stabilization. And there, what is extremely important to note is that it actually takes into account the key objectives that the Union has set up to itself. First, the European Green Deal that was agreed at the December 19 European Council, which was actually the first meeting of the European Council chaired by the President. And so in this context, there is an agreement that 30% of the money, both in the EU budget, in the multi-annual financial framework, and in the recovery fund, in the Next Generation EU, will be devoted to the climate objective. Then, more recently, 2 weeks ago at the early October European Council, which was devoted also to digital issues, that 20% of the recovery and resilience facility will be devoted to the digital transition. So, in fact, this is a package that actually set out, a clear path, for the recovery, but also beyond that to more important structural changes in the EU. And so this, in fact, is fully consistent, actually, with the strategic agenda of the Union. Of course, and one thing that I would like to stress here is that the decision in the European Council, at least this sort of decision, they have to be taken by unanimity. So, in fact, it's remarkable, actually, that you can reach decision by unanimity. It's remarkable and laudable, because all these decisions that are really essential for the future of the Union could be taken in relatively few months. This is, of course, commensurate with the magnitude of the crisis, but it also shows that in an increasingly challenging environment, the European Union matters for all its member states, and that being united actually brings significant value added. So let me come to the conclusion. The first thing is that I'm quite convinced that the July deal was historic, and will find actually its place in future books on the history of European integration. So this will be for the first time the Union will actually implement a common fiscal response of macroeconomic significance, and on top of that, by borrowing on international financial markets. The second thing, and it's also important for monetary policy, we could even say now that for the first time, monetary policy is no longer the only game in town. Now, there are also challenges ahead of us. I think the first challenge I would like to stress is implementation of this deal, implementation of the recovery fund, because successful implementation will be key to sustain trust in policies at union level. So this will be very important. All the decisions that will be taken in the next 2-3 years, and the implementation of these recovery funds, the spending, the quality of the spending will be essential to the future of the Union. The second thing is that, of course, this deal, and I think overall our economic policy response requires a fair degree of creativity. So institutional constraints in this sense have been stretched, but they have not been changed yet. So we are still, living under the same institutional constraints, the same treaty. So we should not forget that this recovery package, and this is actually part of the agreement, has to be seen as exceptional and also by nature temporary. And finally, and I think I will conclude on that, I think looking forward, deeper institutional changes will be needed. At least it's my personal conviction. They are necessary, certainly, to further strengthen the architecture of economic and monetary union. But such change, have not yet been done. So, they will have to be part of future debate. And I have no doubt that they will be part of future European debates. And for example, they will be, I hope, prominent in the context of the forthcoming conference on the future of Europe. Thank you very much.